Good morning and welcome to our webinar today on Is Your Growth Killing Your Business, which is an interesting but somewhat morbid topic. But we're going to go into depth about how growth, which is always thought to be a good thing, can actually destroy your business, the business that you've worked hard to build up. So we're going to go into that in a bit more detail. So before we start, if you have any questions during the webinar, please use the Q&A panel and we'll attempt to answer those questions for you at the end of the webinar. We're using Zoom webinar, so if you're not familiar with it, just make yourself familiar with that right now and we'll get on with the webinar. So before we start, a little bit about me. My name is Paul Swenny and I am a business growth specialist. I'm a fellow of Chartered Accountants Australia and New Zealand, and I've been working with businesses like yours for over 25 years. So we take the whole approach of coaching and accounting right from the startup of a business through to maturity and exiting your business in the most beneficial way. Now, we believe that your business should work for you and not the other way around. So today we're going to be covering this content in an overview, so it's going to be fairly general information. You will need to get specific advice based on your own circumstances from somebody appropriately qualified. But sit back and enjoy. We're going to talk about how we can prevent growth from killing your business. So we look at growth, and most people would think that growth is a great thing for a business to experience. But what we have is there are two different types of growth. We have rapid growth, which tends to happen when there's when you just capture that market and the demand is there. Often that's associated with a new technology or a fad that comes out or a fashion. But what we're more concerned with is sustainable business growth, and that's being able to grow your business in the long term. So a sustainable business growth will mean that in the long term, your business will continue to grow without putting your business at risk, without stressing your cash flow and your profitability. And that's the type of growth that we're aiming for. Not all growth is good. We tend to focus on revenue when we're talking about growth, but revenue growth can actually do a lot more damage than benefit, irrespective of how profitable it might be. And there are a number of reasons for that. So as your organization grows, revenue, the amount of activity required to sustain that revenue increases. And generally with that increased activity, you need to have more supply of working capital, more supply of available cash and funds to support those transactions. So cash flow to purchase materials and inventory, to pay contractors, and to pay all the ongoing obligations of your business. So the more activity, the more you have a need for working capital. And it's that inability to have working capital in place to fund the growth that often has the effect of having a disastrous consequence, particularly for high growth businesses. And it often, unfortunately, can result in insolvency or bankruptcy unless you come in and manage that well right from the beginning. And that's what we're hoping to encourage you to do, is to start looking at managing your cash flow and managing your growth in a sustainable fashion. So history is littered with high growth organizations that have rapidly grown, been very profitable, and then very suddenly come to a crashing halt and are no longer in existence. And that's something we want to avoid from your business. Now, when we talk about businesses that are failing, startup businesses are the first ones that come to mind. A lot of people expect a startup business to fail, particularly within the first 12 months or the first 3 years. And, that doesn't seem unexpected. And, one of the key things that people point to is that startups don't have the capacity to generate the revenue that they need or the cash flow, which may be the case. But what is more often the case is that the startup business doesn't have the amount of capital they need to run the type of business that they're trying to operate. that supports the level of sales activity they need to be profitable and supports the acquisition of new customers in that startup phase. So there is a problem there, is that most startup businesses are often undercapitalized, and startups have, until recently, been unable to get a lot of finance and support. Banks have a reluctance to lend to a startup, and fortunately now we're starting to see the growth of early stage investment types into startups to help them to encourage. So we've seen the growth of Kickstarter, and of more recently some of the Australian government incentives to encourage people to invest in small companies to fund growth. But there's still a lot of work that needs to go on to obtain those kinds of finance, and typically a lot of small startup businesses don't pay any attention to that when they're starting up. So it's no surprise that they run out of cash within the first 12 months to 3 years and end up being just another statistic. But business failure is not limited to startups, and this issue of growing too fast or growing at a rate that damages your sustainability is not limited to startups. A lot of mature businesses will fall into this trap as well. So what a mature business, where they often come unstuck, is in this cycle where they are working on some large sales, and those sales tend to come in. So they'll have some big growth prospects, but they don't pay attention to the funding of how they're going to manage and pay for those transactions. They ignore the working capital requirements of what's necessary to achieve those sales. And that's where a mature business can come into a lot of difficulty. And it's a bit of an irony that by winning big sales or a new contract, new clients, that can actually be the thing that puts your business at risk. You would think that winning sales is a good thing, but what we're seeing is that not every sale is good for your business, and not every type of customer is good for your business. So what we're looking at here is, without overgeneralizing, we want to see sustainable business growth. Okay. Now, generally speaking, if a business is going to double in size, with everything else being equal, it will need twice the amount of working capital to support it. Anything less than that is going to be unsustainable. Now, if the funds are not available to finance that growth, the business risks failure because it's unable to meet its creditors' demands for payment. And even though business might be very profitable, if it can't pay its customers, it's at risk of becoming insolvent. So one of the biggest challenges of managing a growing business is that process of balancing the growth in profit and revenue with managing your solvency and your cash flow. So some of the warning signs that you need to watch out for in a high growth business, or a business that is growing, are the wrong type of customers. Now, there used to be a saying that any customer is a good customer as long as they've got a checkbook and a pulse. And for a long time, that was how a lot of businesses ran. We're very much aware now that not every customer is the right type of customer for your business. Often, and particularly in the startup phase, when there is a need for generating revenue, the wrong type of customers are acquired, and they are wrong in a number of ways, in that they have expectations that don't match the product being supplied, and that failure to meet their expectations causes issues in terms of the status of the business, and damages the likelihood of future sales, or the time you spend servicing those customers detracts from the amount of time you've got available to attract the right type of customer. So that having the wrong type of customer is a common issue. The other one is not having a clarity of purpose. So what is your business really trying to achieve? Now, and this comes back to wrong types of customers. If you're trying to sell your product to everybody, then you're going to not make everybody happy. You're going to make some people happy, but you're going to have a lot of people who are disappointed with the outcome, or it's not exactly what they wanted. So having a clarity about who your right type of customer is, and what the purpose of your product is for them and what pain point that's going to solve, helps in actually making sure that you're selling to the right customer and you've got the right products for them. And that's important as well. So if you're not getting that right, you'll risk selling to the wrong customer. You risk also spending a lot of time and money on activities that are not going to generate the revenue from the right sources. And that's not a good use of your working capital. Unprofitable customers. Now, this is something that not a lot of businesses do, and it's something that we particularly encourage you to do at least annually, is to just review exactly how profitable your customers are. And what we tend to think is high sales value equals a highly profitable customer. But often the case is that the ones with high sales value actually cost you more because you're not you tend to add in a lot of extras when you're servicing them. You tend to make more of an effort to please them. So you'll go and supply extra services, or you'll give them extra attention that's not necessarily required, but it adds to the cost of supplying to them. And what you tend to find is that those larger customers, often the margin that you're generating on them is significantly lower than many of your smaller customers, where you don't need to do all the extra work. So if you charge the same price to your larger customers, or just reduce those unnecessary extras, you could achieve a greater profit on those customers. So if a customer is continually being unprofitable, you need to see whether you should persist with them. So having unprofitable customers is one of those warning signs for a disaster, particularly if you're growing by attracting new customers that are not really profitable for your business. So sales growth where you're attracting customers that aren't actually profitable because they have high needs in terms of servicing, or maybe they're very fussy, or they send a lot of stuff back for a rework that is outside of the scope of what you agree. But so a lot of these new customers can be problematic and can actually be unprofitable. So is that new customer really worth it? So faults in products or services as well is another issue, because often if it's something that you have to fix at your own cost, then that reduces your profit. Now, in a service industry, when you're this is particularly important to get the scope right about what you're actually supplying to the customer for the price. What is included? And scope creep, where the customer expects you to do so much more than what you think you've agreed to, will actually erode your profit. So getting the scope right, but also identifying what level of service is required. Sometimes there is a mismatch between what a customer expects is the completed product and what you do are expecting to say is the completed product, and then they're requiring additional work. Now, where you're delivering faulty products, well, that's something that needs to be fixed as well. And we see that more faults in products and services tend to arise when the business is in a high growth phase, because there is a lot more activity and resources are scarce. So you are pushing things to the limits, things get done quickly, there tends to be a lot more errors, and then you spend more time fixing. So again, you have an increased risk that costs are going out of hand and sales growth is no longer profitable. We're always talking about having recurring customers, so a customer that comes back to you time after time. So the aim is, if you spend time and resources in acquiring a customer, you want that customer to transact with you for a much longer period. So you don't just want to spend a lot of resources acquiring a customer where you're only going to have a one-off contract with them. What you want is that customer to repeatedly buy from you. So the more a customer buys from you, the greater the profit is, but also the lower your acquisition cost for that customer is as a proportion of what you're selling to them. So particularly in the startup phase, because there is a urgent need to win customers, there is a lot more done to acquire new customers, a lot of time invested, and often the amount of revenue generated from some of these customers does not even cover the acquisition costs. So there's a hope that future sales from that customer will cover the acquisition costs. So the initial transaction is done as what's commonly referred to as a loss leader. So you sell the first transaction at a loss in the hope of acquiring more profitable business from the customer long term, which is great. Look, it is a valid strategy, but if you're not getting that customer to come back, then it's just a loss. It's not a loss leader, it's just a lost product. And this tends to happen when people discount to win a customer. So you attract the type of customer that is actually just chasing the discount. They're not interested in a long-term relationship with you. They just want the cheapest price they can get. So if you're selling to that type of customer as a loss leader, then again, you're just selling as a loss. And that's not the type of customer that you want to attract. Another trap, particularly in the startup phase, but the service industries are very much at risk of this, is tailoring each product or service to each particular customer or transaction. And that adds to the cost of delivery. And as you're growing and you're tailoring more and more and more, then the cost of delivering becomes higher. The profit on each sale becomes lower as a proportion, and you need much more in the way of resources. So if you've got a more systemized approach, you can actually deliver more with less resources, and you can increase sales. So having systemized processes on how you do things and not tailoring them for each new customer will help you to deliver more efficiently, which means that you don't need to put on additional sales or administration team, which will avoid having to increase costs and mean that you need lower amounts of working capital to fund those extra sales. Focusing on products that rapidly become obsolete or out of style, big risk for the fashion industry and anybody that's chasing, I guess, the latest trend or fad. That is at risk. Anybody in technology, if you're selling physical hardware, televisions, etc., they tend to come out of date very quickly. Their saying is that they're out of date before they even reach the shelf. So if you're focusing on that, maybe if you're overstocking on particular products, then you're not going to be able to sell them. Or if you are able to sell, you often have to sell at very little profit or even below cost. And that's not something you want to be left with having as a last resort. So watching your stock levels and making sure that you're not committing to products that are going to go out of style quickly. Not having the cash and working capital to fund expansion. And this is something that is the cornerstone of why a lot of businesses fail, is that when they're going through a period of growth, is that they don't have adequate cash or working capital to fund that growth. And that is a key concern. We're going to go into that in a bit more detail. We're going to look at an example. But a couple of more warning signs is just ignoring the new entrants to the market and alternative products. We look at examples like Kodak, who ignored the digital market, the digital camera market, the taxi industry upstaged by Uber and Lyft, and new entrants to the market. You can't just assume that you're going to be able to keep that sales growth going without keeping an eye on who your competitors are or what alternative products are, and keep focusing on how you can improve. So innovation and improvement as well. Failure to do that. A large software supplier back in the early 2000s didn't believe they needed to do much in the way of innovation, and as a result their product didn't keep pace. Along come the new players who innovated and looked at a different way of doing it, and they've captured a significant amount of the market share. So by not innovating and not looking to improve, just the way we've done things before has worked. Well, that's not necessarily a guarantee that the way things are going to happen in the future. If you keep doing the same thing, you're not going to get the same results, because your competitors are going to improve, they're going to innovate, and they're going to leave you behind. And the last one, this comes up quite a lot, is the business owners working in the business and not on it. If you're too busy in the business just doing the day-to-day transactions, you're not focusing on the overall direction, the profitability, or the strategic areas that you should be focusing on for your business. You're not creating that business that works for you. You're working for the business and you've just created a job for yourself. And that's, unless the financial reward is there, then who wants to be doing that? You might as well go and get a job working for somebody else. You've got a lot less hassle and you can just avoid all the stress. So working on your business can avoid some of these risk areas. So we're going, as I mentioned, we're going to look at an example. We're going to look at Jonathan. Jonathan's a typical small business owner. He took over his business a year ago and growth has accelerated. The primary product of his business is brought in from overseas, and the business is operating on a budgeted turnover, roughly 70 to 100,000 per month, which is a pretty average, solid small business. And the working capital in place, is adequate for what he's operating at now, but that's already a step up from when he bought the business a year ago. So Jonathan's been quite fortunate. He's got a number of growth opportunities presented to him. So he's got 5 major sales all lined up, within the $50,000 to $200,000 range. So we're looking at a significant increase in his revenue. So let's say that could be another $500,000 of revenue, which is a big growth in sales for a business his size. Those customers would expect delivery of the product within 3 months. But to get to those sales at that level, Jonathan is going to have to discount his price to secure the sale, which is going to mean automatically a dip in his gross profit margin, which is not a good start. Selling below your current margin means that you are reducing your capacity there. So if Jonathan successfully achieves these sales, its turnover is going to go up from the $100,000 per month he's currently experiencing to up to $250,000 per month for the next 3 or 4 months, which is and that's a very good increase in sales. Very, very welcome to increase your sales by that much in such a short period. Now, we did mention that Jonathan imports his product, and the supplier that he deals with overseas doesn't give him trading terms. So Jonathan is usually required to pay up front for any purchases. So to fund this extra $500,000 of sales, Jonathan will have to pay for the stock up front. So the major risk for Jonathan is this high amount of cash required to fulfill the sales. Now, these sales opportunities may have come up very quickly. So even though he's been working on growing the business, these sales have all come to a head at the same time. And it would be nice to spread out the growth, but it's all come at the same time. He wants to take advantage of this and not lose any of the sales. But to do that, he's going to be stuck in a situation where he's going to have to fund the purchase of all the product to supply up front. And then he's not going to get paid for 3 or 4 months. So we're looking at about $250,000 he's going to have to fund. So what we need to do with Jonathan is we need to actually know what his cash flow position is. So with Jonathan, we've done the analysis and we know that he needs between $200,000 to $300,000 more cash. Now that's going to be very tight, particularly when Jonathan's been turning over $1 million of revenue, and all of a sudden he's got to come up with an extra $200,000 to $300,000 to fund these sales in the next 3 to 4 months. And that's a lot tighter than Jonathan first thought when he was getting excited about these new sales. Now, there are a couple of things there, and we're going to talk a bit more about options in terms of how you fund these additional sales. One of the options that Jonathan was able to achieve in this situation was to talk with his customers and stage these orders. By further discussion with them, he realized that they didn't actually need, or not all of them needed the sales at the same time. Some of them didn't actually need the product delivered for another 3 to 4 months. So he was able to stage those orders and spread out his cash flow requirements. So instead of needing an extra injection of 200,000 to 300,000, the amount required was much less. And that's a much better outcome. But without doing that analysis, there's a sudden surprise, which is never a pleasant one. Now, you're not always in a position where you've got the luxury of working with your customers and spreading out that cash flow. So there is a lot more planning involved. So yeah, Jonathan worked out there was a gap of 60 days and we needed an extra $250,000 in there. So there are a few options there that he could have done. So we could have got a term loan or an extension of a bank loan. Generally, the bank wouldn't lend for such a short period as a term loan. So he'd be taking out borrowing with a much longer term. Now, to purchase the product, the cash would have been needed very quickly. Time to put in a bank application and get that approved is, and currently taking, 6 weeks to 3 months to even longer in situations. So there was no guarantee that that facility would have been available. Now, had Jonathan started, done the cash flow analysis several months before, as he was starting to woo these new customers, he may have been able to put in place an application with the bank and have that loan approved or the finance approved before he got the committed sales. So it was there. Startup businesses, they'll often rely on credit cards, certainly not for the level of spending that Jonathan's looking at here, but a lot of startup businesses rely on credit cards, and the danger there is, of course, very high interest rates, and you get into a spiral of not being able to repay them. Some people look at drawing off the home loan, but again, you're putting your personal assets at risk by doing that, and it's not necessarily a good match of the use of funds to the source of funds. Now, there are other options. Jonathan could look at trade finance, where the bank would finance the funding of the purchase of the products in the time period. So the timing in that situation, the timing of the facility matches the needs of the cash flow. And that may be the best situation for Jonathan in that situation. To use something like a trade finance facility there, where he can, the bank would finance the purchase, and he's not having to come up with a large sum, 250,000 in a very short space of time. So that would be a solution for Jonathan there. So how do we achieve profitable growth that is sustainable? Well, the objective is to create a business that efficiently uses your resources and generates revenue at lower resources costs than your competitors, but also grows within the limits imposed by your cash reserves. And that's what we mean by sustainable growth. Now, it's very common that rate of growth that is sustainable for a business is often between 5 and 10%. That means that a business can grow its revenue by 5 to 10% without needing an extra source of capital. So an extra source of funding, so it doesn't need to borrow, doesn't need to finance. So that's about the level that most businesses are structured for. So between 5 and 10% growth is sustainable. If you're looking to grow at a rate exceeding that, then you do need to do some careful planning on terms of how you're going to fund that growth and what facilities are available, and start planning for that now. So the issues for growing business, cash flow is the major issue. Cash flow is the major issue. And we see this again and again. And for others, it's profit, but profit and selling below profit will affect your cash flow as well. So the lower price that you sell for, the less cash you'll have available. And this is particularly a problem where a business relies on large customers with large orders. They'll often expect you to cut your margin, or they might ask for discounts if they purchase more from you, or they might ask push out your payment terms to suit themselves, which puts a strain on your cash flow. So even though there are other issues, a lot of it comes back to the cash flow. So cash is the danger for businesses. The other danger is sales, and this is where sales, we've talked a bit about this already, is that salespeople often get carried away with the headline number. So that means the actual sales figures. So particularly where you've got sales incentives for your sales staff, they focus on just selling. They're not concerned so much with the profit or the cash flow. Their only concern is with sales. So they will go out and sell to the wrong type of customer, to the unprofitable customer, or the customer that doesn't pay, because they are focusing on sales. And even some of the big sales, they're just simply not worth it. So you need to achieve profit, and you need to sell only to people who are going to pay you on the terms that you need. So the higher your costs, the lower the chance of your, you can play around with your sales margin. The higher your fixed costs, you need to maintain that margin. If you've got higher variable costs, you've got an opportunity there to perhaps look at selling more efficiently or gain some economies by selling more. So you might be able to actually, in fact, reduce your cost per sale by selling at a higher volume. So it's important to know what your break-even point is before you go into any details, and also have a look at what areas are your people selling to, and are you encouraging the wrong kind of sales behavior? So growing sustainably is not something that just happens by accident. It does require careful planning. So what we need to do is we need to have a strategy in place. And this is where it comes down to working on your business, which is what we're always talking about, working on your business and looking to increase the number of the customers that you have, which are the right type for your business. So focusing on the right type of customers, not the wrong ones, increase those customers. Recurring revenue, again, create recurring revenue from customers and get them to purchase repeatedly from you. So this is where you can reduce the acquisition cost of a customer proportionally on the sales by getting them to buy from you more. You don't want to spend a lot of time acquiring a customer if they're only going to purchase from you once. So achieve a recurring revenue stream from your customers and price your product for profit. Analyze your profitability. Some of your products may not be as profitable as you think, particularly in the service industry where you put a fixed price on the service. Is that service actually profitable? It is quite interesting to do this analysis, and often you will come up with a conclusion that some of the services you thought were profitable are not in fact profitable. And with those, there's often an opportunity to increase your price because it's a service people depend on. It is something that they would easily pay a higher price for. So adjust your pricing and price your product for profit. Becoming more efficient in how you deliver. We talked earlier about systemizing your processes, improve the way things are manufactured or your sales process so that it's more efficient. There's less errors. It takes less time. So the more efficient your processes are, the less costly they are to operate, and the quality output is much improved. And that's something that is really important. You want to reduce the rework and the poor quality. So having good, consistent and efficient processes will help with growing sustainably. And then look at, in terms of growth, identify, and this is where the analysis comes in, that you need to have a look at how much capital do you need to fund the growth that you're after. So do you have the capital in place? If you don't, where are you going to get it from, and what's going to be the right kind of financing facility? So there are things we've talked about in your business that you can work on, but there is one other trap that catches every kind of business. And that's the tax trap. And this is something that we see particularly with the way the tax payment system works. Now, the tax trap is particularly a big sting for startup businesses, but also affects growing businesses. So what we're going to do is we're just going to quickly go through some figures because I want to highlight how this is a trap and particularly affects your cash flow. And if you're a growing business, this you need to plan for because you're going to get caught and it's going to hurt if you don't plan for it properly. So the tax trap here for a startup or growing business, so we're going to look at some figures here. Let's say our base year is going to be 2018. The business has got $1,000 of revenue, $1 million of revenue. We've profit of $200,000, and let's assume that we're able to use the tax rate of 27.5%. So we have $55,000 of tax to pay, and we're going to lodge that return in March 2019. Now, what happens when we lodge the return is we have the pay-as-you-go installment system, where you are required to pay installments of tax for the following year based on your most recent tax return lodged. Now, the Australian Taxation Office will assume that you're going to make the same level of profit, and they're going to require you to pay by quarterly installments, which are going to be due the 28th day of October, February, April, and July. Now, the sting here comes that after lodging your tax return, we are often going to have a catch-up installment for the following year. So we've lodged our 2018 tax return, and we've got $55,000 of tax to pay. So we've lodged that tax return in March, and then we get our June 2019 quarterly pay-as-you-go installment, where the ATO says we're going to do this as a catch-up, and all of a sudden we've got another $55,000 of tax to pay. So we now have $110,000 of tax to pay within a 4-month period. Ouch, that hurts. Then we have another $13,750 due just 3 months later. So very quickly, we have $123,750 of tax due to be paid within approximately 6 months. So in 6 months, you're paying effectively 2.25 years of company tax in this example. Now, unless you've planned for that, that's going to come as a big surprise. And unless you've got the cash flow and working capital in place, that's going to put a huge strain on your cash resources. And you are going to need to put something in place very quickly. And as soon as you do have tax debts, it does start to impact on your borrowing capacity. So that's something that we need to plan for early on. And this particularly affects startup businesses where they aren't in the pay-as-you-go installment, but it also affects a growing business. And this is the example we're going to use here. So we're now moving forward to our second year, and the revenue's gone up from 1 million to 2 million, and the profit's gone up from 200,000 to 500,000. So the tax on that is 137,500. But our installments that we've paid for 2019 were only $55,000. So we still have $96,250 of tax to pay. And again, we're looking at the same lodgement period. So we're looking to lodge it around March with the tax due that time. Now, if we go forward to the 2020 pay-as-you-go year, we would have paid 3 quarterly installments totaling $41,250. And again, there'll be that adjustment on the June quarter to bring us up to speed. So we're looking at an adjustment there of $96,250. And we can expect our installments for 2021, apologies for the typo there, 2021, the quarterly installment is going to go up to $34,375. So again, we have a situation where our tax payments within a 6-month period are going to be quite excessive. We've got $213,000 of tax payable within that short period, lodging from, say, April through to October. So that is a sting, and you do need to plan for how you manage your cash flow. Cash is really important. Planning for how you allocate and spend your cash and how you fund the growth are critical. So we've spent a lot of time working on how you can improve your cash flow, and we have come up with some strategies. So the good thing is we've put some of those ideas for you into an ebook, which you can download from our website or download from the address there, bit.ly/premium, and you'll be able to download our free ebook, which will give you some strategies on how you can start improving your cash flow today. Now, cash flow and working capital go together, particularly when we're looking to prevent a business from growing too fast that it ends up spelling disaster. So remember that growth that's not sustainable can quickly get out of control and spell disaster for your business, and that's something we want to avoid. So let's focus on growing sustainably, plan for growth, plan for how you're going to fund that growth and get your cash flow in order. So thank you for tuning in today. It's great to have you with us, and I hope you can join us next time. As always, if you want to connect with us, can connect with us via email or via our social media platforms. So thank you for joining us, and have a great day.